Good to be back with you. This is Wade into Wealth. I'm Chuck Wade, as always, joined by my younger, slightly better looking, certainly more bald brother, Ethan. Although the bald is by choice.
Yeah, I'm pretty sure I could grow more hair than you if I wanted to.
I
thought about it hard enough, I think I could make it work.
I have not seen hair on your head since you had
it was since I transferred to Batavia when I was a junior in high school.
Okay. And then the only hair I remember you having is that epic bowl cut.
It was terrible hair.
It was a terrible bowl cut.
I remember I didn't have a bowl cut when I was in high school, but my hair,
your hair was
when
not
it was
great
growing out,
then.
it was not great. No, I had cowlicks all over the place. But I remember the hairdresser. I went to Mom's hairdresser, and she screwed it up so bad that I just shaved it and thought, that actually doesn't look bad. So I was a junior in high school. Yeah, I've shaved my head ever since I was a junior in high school.
Yeah, I don't remember. I just remember you with that epic bowl cut as like a 6-year-old.
I mean, who didn't have it in that
No,
time?
I had a bad one too.
Even Brenna had a bowl cut.
Yeah. My wife did too. Liz
had
a bowl cut
it's
too.
like, who didn't have a bowl cut
I know.
at that
It's
age?
a rite of passage that
for our generation,
that you have
absolutely.
an awful bowl cut at some point in life. I think that's fair.
And for every boy, if you had a Nintendo, you loved Tecmo Super Bowl.
Yeah, sure did.
Mm-hmm.
More impressed by the bowl cuts, but that's not likely why you're here to join us today, which I can understand. But speaking of being kids, you remember, I'm going to assume, when our dad coached basketball and did that for many years successfully at the high school and collegiate levels. And I remember one night after a loss, him sitting at the kitchen table and just talking about how the wins didn't feel as good, but the losses still hurt just as much. Do you remember that?
I do.
Uh-huh.
You know what else I remember?
What?
After he won states, for some reason, we had gotten home, and I think we were in the green minivan. Probably had the green minivan then, or it was a silver one. I don't remember.
It was a minivan.
It was a minivan, yep. Color to be determined. But I had the state trophy.
Yes.
I had the plaque.
I remember.
And I was getting out of the back seat of the van. Sure enough, dropped it right on our gravel driveway. I can still picture in that
chip?
part of the chip that was out of the trophy. Yeah.
Well, if you go
probably not even a day old, that trophy wasn't.
Well, no. If you go into Notre Dame High School in Batavia, you'll find a chipped 1999 New York State Championship girls basketball trophy. And the chip is thanks to you dropping it in our driveway. I remember that. I don't think Dad was too happy, but the fact that they had just won the state title helped.
He wasn't that mad.
Wasn't him not be as mad at you.
You know what? That trophy has character now.
It does. It does.
Probably the best looking trophy in that case.
It's a distressed trophy.
Yep. But
I remember Dad talking about this in that how it got to a point where the losses actually hurt more than the wins felt good.
Yeah.
And
well, that's human nature.
Yeah.
Too. And I think investing is a lot like that.
Yeah, absolutely.
And that's, in a lot of cases can be detrimental because as we have a saying that the pain of a dollar lost is far greater than the pleasure of a dollar made.
Yeah.
And, that has the ability to stop you in your tracks.
Market can go down 10%, 20%, 30%, and it becomes big news very quickly.
Sure.
Once we dip into a correction, which would be a drop of 10% or more in an index, that's news. People notice that. It certainly becomes a little busier. The phone rings a little more when that happens.
Yep.
Yet a 5-year span when the S&P 500 more than doubles, returns 102%, it goes barely noticed in the grand scheme of things.
Mm-hmm.
And that's what happened from 2017 to 2022.
It's barely newsworthy.
It's not newsworthy.
Right. And it comes down to the whole idea, the pain of a dollar loss is far greater than the pleasure of a dollar made. But when we open up our account statements and we see our account down 10, 15, 20, in some cases $100,000, $200,000, that's not we think, whoa, well, maybe we shouldn't go out to eat tonight. Maybe that's going to change our retirement picture. What can we do to try to get this under control? Yet, when that account statement comes and it's the opposite, you're up 10, 15, 20, 100, $200,000, you look and say, well, that's nice. And then you go about the rest of your weekend exactly as you otherwise would have. It doesn't stop you in your tracks.
Very few clients call after making 25, 30% and say, I'm going to buy that new Corvette.
Yeah.
We're taking that vacation to Bali or the other side of the world because we made money this month. You're absolutely right. Why? Fear and uncertainty. Those
Well,
are
and it's natural as human beings.
absolutely.
That, it's when someone pays you a compliment versus when someone criticizes you, that criticism sticks with us longer.
Yeah.
The compliment, in a lot of ways, I know I try to do a better job of this,
Mm-hmm.
doesn't soak in. Instead, it kind of wicks away, but that criticism just kind of sits and stirs, and that's just human nature.
Yeah. Yet when you stop and think about it, that compliment to someone else can, because we're so used to it, so used to negativity and
Yeah.
pessimism. When you
Yeah.
do get a nice compliment from someone, you bought me a cup of coffee the other day. It was on my desk. Made my day.
Yep.
I was really appreciative of it. So, but to get back to it, fear and uncertainty, they affect us most. And along with regret, those are the truest and largest costs of investing.
Absolutely.
And that's our podcast today. We're going to talk about the cost of investing. And this is not a podcast about, well, how much does it cost to invest, or how much does your financial advisor get paid, or how do you pay your advisor? Go listen to episode 63. We talked about that there. That is not the cost of investing. The cost of investing is what we bear and shoulder in order to generate consistent returns over a long period of time. In short, to create wealth.
To build wealth, yeah.
To build wealth. From 1950 to today, the S&P 500 has returned over 260,000%.
Yep.
It's 11.5% a year. So it's 72 years. It's 11.5% a year.
That's over a long period of time.
That's over a lifetime.
We're not talking about 2 years.
Nope.
We're talking about multiple market crashes in that time.
Yeah.
Serious downturns, plenty of corrections, 34 corrections to be exact, in those 72 years of 10. A correction is technically a drop of 10% or more in the stock market. 34 of those, and yet it was still up 260,000%.
So that's the question. That 11.5% annual return. If you can look at an investment and say over 72 years, it's returned 11.5%, you probably don't have that many questions about if it's a good investment.
No, I mean, the statistics tell you that it's a
Right.
good investment.
But was it free?
No.
No.
There's one saying I particularly like, which is that volatility is the price you pay for superior returns.
Yeah.
And what does that mean? Volatility is fear. Volatility is anxiety, because you are compensated. The returns that you get compensate you for the risk that you take. If you don't want to take a risk, put your money in the bank account. You won't make anything off of it, but it won't go down. You don't have to worry about
Right.
that. If you want to generate good, consistent returns over time, the cost that you have to endure are the challenging times where you see the market go down, which provoke fear and anxiety.
And the loss of control.
Complete loss.
That's
of
what
control.
I was just
Yeah.
writing it down. We fear the loss of control.
Yep.
It's very uncomfortable to have something be out of your control.
And you don't have to be a control freak to have that
No.
bother you.
No, not at all. So let's think about this. 72 years, 11.5% return. Sounds good. And it is good. During that time period, there have been 11 recessions.
Mm-hmm.
11. And the two most recent, pretty rough. COVID, March and April of 2020, when the S&P 500 dropped nearly 40% in a month and a half.
6 weeks, yeah.
It was not fun. And the Great Recession, 2008. If you were alive, if you were investing money during those time periods, you sure as heck remember.
Yeah.
34 corrections of 10% or more in the past 72 years. Basically, 50% of the time we have been in a correction, or the markets have been 10% or more off their highs. When
Yeah.
you stop and think about that, that is a staggering statistic.
It is. And I think when we talk about it in terms of today, because we've had a pretty good run of 5 years
Yeah.
with the markets, and psychologically, it's easy, if you're not watching this every day, it's easy to kind of get drawn into the idea and the concept that, well, markets just kind of go up. They don't.
Yeah.
They don't. On average, you see a correction, 10% drop or more, whatever, 18 to 19, 20 months.
Every 18 months, every
Yeah,
year and a half.
every 2 years,
Yep.
basically,
Yep.
as these statistics provide. So corrections are not abnormal. In fact, they are normal.
They're healthy,
But-
they're not a bad thing.
No, it's normal. It's going to happen. but we've kind of been drawn into this lull of, well, markets have been really good for the past couple of years.
Past decade plus.
Yeah.
Really, 12 years.
And the market crash of the pandemic lasted 3 months.
Right.
I was looking at a client's performance report recently, and you look at 2020, and 2020 is just straight up.
Right.
So, but that's because it's only
Start to
reporting for
finish.
the year.
Right.
It doesn't talk about the almost 30 or 40% decline in 6 weeks that we had there in March. And it's not even a blip on the radar anymore at that point. But
yeah. So why is it so hard to see? Why are the costs of investing? Because these are the true and absolute costs of investing.
Yep.
The cost of investing is fear, it is uncertainty, it is potential regret.
Yep.
Why is it so hard to see?
because it's unknown.
There's no price tag.
Yeah,
There's no sticker.
right. There's no, you
Right.
can't advertise what the returns. We don't know.
Right.
No one knows. All we can look at is at historical returns,
Mhm.
and our regulators will be the first people to tell us that historical returns can't promise future returns, and they can't be used as a method to
Right.
align for that.
Well, let's say you want to go buy a house or a car. The
Mhm.
price is listed,
Yep. Sure.
right? And if you want to buy a car, there's a couple of ways. If you need a new car, there's a couple of ways to pay for it. You can pay for it all in cash. You can take out a loan. You can go look for, if you don't want to pay that price for a new car, you can go buy a used car.
Yep.
There are different options. The third option, I guess, would be to try to steal one. Probably avoid that one.
Probably.
Would recommend
Yep.
avoid that one. For Lori, our compliance officer, this is not a recommendation to go steal a car. Don't do it. But with investing, we can't look at, there is no price tag. There is a price tag for basically everything we purchase. But in investing, there is not. Yet what often people try to do is what I would liken to that third option. They're not necessarily trying to generate returns by illegitimate means, but trying to generate returns in ways that don't work or are going to get you into trouble. Timing the market.
And are not sustainable.
And
A
are not
proven
sustainable.
practice.
Right.
Repeatable. I mean.
Exactly. There is no sticker that states the price. You can't look the cost up online, nor can you lock in a price or reserve one. And we don't know when it's coming.
Mm-hmm.
That's the other part that is so challenging. So what do? I think we need to look at and reframe the way we think about investments and the way we think about paying for them. We're asked often by someone who may be interested in working with us or interested in working with a financial advisor, well, what does this cost?
Right.
And they're asking about a dollar amount. But the reality is the cost is the uncertainty, is the fear, and the potential regret. So what do? I think we need to reframe how we look at it. I think we need to make a conscious effort to look at corrections in the stock market, drops in the stock market, recessions as simply the cost of doing business.
Volatility is the price you pay for superior returns.
And when we do that, if we are willing to try to shift our perspective on this a bit, the next time this happens, and it's going to happen again, there will be a next time. And I've started telling clients who, let's say someone in their 60s, hey, you know what? I hope you have 10 more of these corrections. That means you're living a long life. There's likely to be many more ahead of us. If we're willing to just look at it as this is the cost of doing business, what we pay for superior returns, it allows us to not feel that need to panic, to retake control, to make adjustments or changes or shift things around with our investments in times of turmoil, and simply to accept this is the cost of doing business. And then we avoid that future regret, which is the greatest cost of all, which is, I wish I hadn't done that.
Yeah. We have to accept it and accept that it's normal, because it is.
It is. It's happening. And if you go look at the course of history, we just discussed it. We have been in a market correction 47% of the time in the last 72 years.
And we will be for probably the next close to 50%
And
of
we
the time.
likely will be for the next 72 years as well, if we're willing to accept that.
If you're willing to accept it, you will be rewarded for that.
It's very simple. So That is the cost of investing, my friend.
And that is this week's episode.
I like it.
Mm-hmm.
Bring it home. We do appreciate you being with us. We'll be back again soon with more Wade into Wealth.